As the US employment report for July and Canada's employment data are still to be released, we take a look into what next week has in store for the markets. On the monetary front, despite policymakers from central banks around the world taking a break, there are still some which are scheduled to make statements and could sway the market's opinion. As for financial releases, the calendar tends to ease, and we have an early start on Sunday with the release of China's trade data for July. On Monday, we get Japan's current account balance for June, as well as Eurozone Sendex index for August. On Tuesday, we have a rather slow day, while on Wednesday, we get China's PPI and CPI rates for July, and we highlight the release of the US CPI rates for July. On Thursday, we note the release of the US weekly initial jobless claims figure, as well as the US PPI rates for July. And on Friday, we get from the UK the GDP rates for June and Q2, Eurozone's industrial output for June, as well as the preliminary University of Michigan consumer sentiment for August from the US. The US dollar is about to end the week near the same levels it began on Monday, yet the US employment report for July, which is still to be released, could alter the greenback's direction. On the monetary front, we note that Fed policymakers seem to maintain a rather hawkish tone. It's characteristic that Minneapolis Fed President Kashkari, a well-known dove, particularly stated that the more likely scenario is that the Fed is going to continue raising interest rates and then would sit there until they have solid evidence that inflation is well on its way back down to 2%. It's understandable that when even a dovish policymaker makes such comments, that the Fed's intentions are clearly leaning on the hawkish side, which could provide some support for the greenback, as monetary policy differentials could favor it. On a more fundamental level, we highlight US House Speaker Nancy Pelosi's trip to Taiwan, the first of a high-ranking US official in 25 years on the island, which intensified the frictions in the US-Sino relationships, creating market turbulence and safe haven inflows for the greenback at some point of the week. The Chinese responded angrily, yet in a restrained manner, which tended to ease the market's worries somewhat. On the other hand, we may see China maintaining the issue, which could re-enhance market worries and hurt riskier assets and favor safe havens. In the coming week, we highlight the release of the US CPI rates for July on Wednesday, and the headline rates are expected to slow down, and if actually so, could imply that inflationary pressures in the US economy have peaked, something that could ease the pressure on the Fed to continue to hike rates at a fast pace. Also, from the US, we note the release of the weekly initial jobless claims figure on Thursday and the PPI rate for July on the same day, while on Friday we get the preliminary University of Michigan consumer sentiment for August. The pound is about to end the week slightly lower against the US dollar and JPY and notably lower against the euro. BOE's interest rate decision may have weakened the pound. The aftershocks of yesterday weighed on the sterling, closing the day in the reds as the 50 basis points rate hike was largely anticipated and already widely priced in. On the other hand, though, the bank struck a tone of uncertainty as it stated that the next rate hikes are to be data dependent, and characteristically, the bank stated that policy is not on a preset path. Moreover, the failure of BOE's members to deliver a unanimous vote came to surprise at the time of the release, raising credibility concerns alongside BOE's grim warning of a long recession ahead for Britain. The pessimistic outlook seemed to weigh on the pound, and that's why we highlight the release of the UK GDP rates for June and Q2 on Friday. Should the GDP rates actually start to slow down or even drop into the negatives, that would practically reaffirm BOE's negative outlook for the UK economy and could weigh considerably on the pound. On the other hand, the bank's warning seems to also help the market to anticipate and price in such negative data. Please note that on Friday, besides the GDP rates for June and Q2, we also note the release of industrial output for June, the manufacturing output for June, and the trade balance for the same month. JPY seems about to end the week at the same levels it began, as well as against the GBP and Euro. Yet the description fails to describe the rollercoaster ride for the past 2 days of JPY traders. Overall, we continue to highlight how BOJ's dovish monetary policy continues to affect the JPY and is of key importance for its direction. We note that officials of the Ministry of Finance in Japan seem to be foreshadowing that the bank may have to abandon its 0% cap on long-term interest rates. It's characteristic that Reuters reported that Ministry of Finance official Saito we must bear in mind the BOJ's current policy won't last forever. Sometime in the future, it won't buy as much bonds as it does now and will no longer peg interest rates at the set level. Such a scenario could provide some support for JPY, yet seems to be still in the distant future for the time being. On a more fundamental level, we tend to note JPY's dual nature as a national currency and a safe haven. Should there be tensions in the international political scene, we may see JPY gaining as investors may fled to its relative safety. As for financial releases, we would like to note the release of Japan's current account balance for June, as well as the corporate goods prices for July. The common currencies seem to remain relatively stable against the US dollar, the JPY, and gained slightly against the GBP. On a more fundamental level, the worst for Eurozone's economy due to the war in Ukraine and the tensions within the relationships with Russia are still intense. The possible insufficiency of natural gas supplies from Russia still looms over Europe like a spectre. On the monetary front, ECB's pivot in its latest meeting towards tightening its monetary policy is still present, and the pressure seems to be rising to deliver another 50 basis points rate hike in September meeting. The issue of fragmentation of borrowing costs for member states of the Eurozone is still an issue, especially for countries like Italy. Yet, as Bloomberg reports, the bank seems to have deployed billions of euros in bond purchases to shield Italy, displaying its determination not to allow the spread of borrowing costs between member states to widen out of control. The flexible reinvestment of the Pandemic Emergency Purchases Program seems to be the first line of defense for the bank currently, and not the transmission protection instrument, which tends to imply that the bank's policy also carries a substantial degree of depth with it. As for financial releases, we would like to note that the contraction of economic activity across sectors and member states, as signaled by the preliminary composite PMI figure of the Eurozone for July, was reaffirmed, which was a negative on a macroeconomic level. Yet Germany's trade surplus widened, creating some hopes as the economic powerhouse of the area regained its ability to export products. In the coming week, it's about to be a rather slow week regarding financial releases, yet we would still like to note the release of Eurozone's forward-looking CENDIX index for August on Monday, the final HICP rates of July for Germany and France on Wednesday and Friday respectively, while on Friday we also get Eurozone's industrial output growth rate for June. AUD seems about to end the week near the same levels the week began on Monday against the US dollar, despite some increased volatility being present. Especially RBA's interest rate decision on Tuesday tended to weaken the Aussie. It should be noted that the Aussie tended to weaken against the US dollar despite RBA delivering a double rate hike, as was widely expected. In Governor Lowe's accompanying statement, it was reaffirmed that the board expects to take further steps in the process of normalizing monetary conditions over the months ahead, but it is not on a preset path. The size and timing of future interest rate increases will be guided by the incoming data and the board's assessment of the outlook for inflation and the labor market. The fact that the bank stated that there is a degree of uncertainty in its future rate hike path, given that it is not on a preset path, allowed for the Aussie to drop and could weigh as the bank relented a part of its decisiveness. In the coming week, given the low number of high-impact financial releases from Australia, we expect fundamentals and market sentiment to be the primary factor behind the Aussie's direction. Should the market sentiment be positive and more risk-oriented, we may see AUD getting some support as a commodity currency. On the other hand, should the tensions in the US-China relationships escalate further, we may see the Aussie weakening given the close ties of the Australian and the Chinese economies and the wide amount of raw materials exported from the land of the Down Under to the Red Dragon. Hence, we highlight the release of China's trade data for July on Sunday, especially the import growth rate. We would also like to note the release of China's inflation metrics for July on Wednesday, while from Australia we note the release of the consumer sentiment for August and business confidence as well as business conditions for July, all on Tuesday. The CAD remained rather steady against the US dollar in the past few days, maybe with some slight losses, and the drop of WTI prices may have adversely affected the loonie. It should be noted that the positive correlation between oil prices and the CAD was on display once again, maybe though not to the extent we expected. Oil prices slid lower in the past few days despite OPEC announcing meager increases in production levels for the commodity, which underscored the limitations in the capacity of major oil-producing countries. On the other hand, we must note that US oil reserves tended to balloon further, as both the AP and EIA weekly oil inventories figures showed. The issue seems to be intensifying as problems are reported in exporting the commodity out of the US, and we may see oil reserves in the US rising further in the coming days, especially for cushion. Should that be the case that we see oil prices slipping further, we may see intensifying the bearish tendencies for the CAD. On the monetary front, we expect BOC's monetary policy tightening intentions to be maintained, and thus could provide some support for the CAD. On a more fundamental level, we expect, given also the lack of high-impact financial releases, the market sentiment to be the main driver for the loonie. Should the market sentiment be more risk-on and positive, we may see the commodity currency getting some support and vice versa. Also, please note that Canada's employment data for July are still to be released later today and could alter the CAD's direction before the week ends. As a closing comment, we expect the greenback to maintain its initiative over other currencies in the FX market, given the number of high-impact financial releases stemming from the US, with the highlight being the CPI rates for July on Wednesday. On the other hand, other currencies could also come under the spotlight, once again in certain times. Overall, we would like to note that we are about to enter a holiday period and we may see low volatility being present for the markets, while in regards to US stock markets, we expect the earnings season to continue to keep traders busy, yet the number of high-profile companies releasing earnings reports seems to be narrowing, which could reduce interest of traders, especially in the periphery, rather than the core of the markets. Last but not least, we must note that gold's price was on the rise for a third consecutive week, as the precious metal capitalized from the up until now relative inactivity of the greenback. We expect the negative correlation with the US dollar to be maintained in the coming week and could define gold's direction.
Hello, my name is Christina, and today I will talk about swaps. You've probably heard traders talk about swaps and rollover before, but to understand these forex trading terms, you should first consider what interest is. Each currency has an interest rate connected to it. Since each forex trade involves two different currencies, it also involves two different interest rates. When trading in the forex market, very often, traders may leave their trading positions open overnight. These positions are carried forward automatically the next day, and an interest rate is charged. The interest rate that is charged is determined by the interest rate difference between the two currencies of the pairs which you are holding. Your account is then credited with an interest rate cost called rollover or swap. A swap then arises due to the overnight interest rates for each different currency. By rolling over the position, the trader extends the settlement period by another day. The beginning end of trading day is considered to be midnight. All positions left open from 11:59 and 45 seconds to 11:59 and 59 seconds will be rolled over to a new value date. As a result, positions are subject to a swap charge or credit. If you open and close position before 11:59 and 45 seconds, you will not be subject to a rollover. Since each currency is borrowed or sold, you can either be receiving or having to pay interest. At the end of a trading day, if a trader entered a long position in a high-yield currency relative to the currency they borrowed, they will receive a certain amount of interest on their account. On the other hand, a trader will need to pay interest if the currency they borrowed has a higher interest rate relative to the currency they bought. The rollover cost is based on the interest rate difference between the two currencies. Let's say the interest rate in the EU and USA are 4.75% and 1% per year, respectively. As we noted, every currency trade involves borrowing one currency to buy another. If you have a buy position of 1 point lot in Euro USD, then you earn 4.75% on your euros and borrow US dollars at a rate of 1.5% per year. IronFX offers Islamic accounts, known as swap-free accounts, for traders who cannot earn or pay interest due to their religious beliefs.
In today's session, what we're going to be doing is we're going to be doing our strategy clinic, right? So if you have questions on your trading strategy, which you'd like me to diagnose, right? Maybe you have a moving average crossover strategy, or you have a strategy on Fibonacci, Elliott wave, right? In today's session, you get to ask me all the different, you get to share with me, right, the trading strategy they have, and I can give you my professional perspective on it. All right, guys. Now, before we begin, a quick disclaimer that everything in this webinar is educational in nature, so nothing should be construed as investment or trading advice. All right, so please do your own little due diligence before you guys trade. Okay. Now, let's begin. Let's begin today's session. All right, let's begin today's session. If you have any requests, right, let me know too. All right, just a quick introduction of myself. My name is Desmond Leong. I run the award-winning research firm Everest Fortune Group and also the Forex Army. So we are finalists for the best FX research and best equity research in 2019, 2020, and 2021. So we usually have a strong team of traders advising the banks, the brokers, the hedge funds on where the markets are heading. We have a special partnership with IronFX where we are bringing you guys the good stuff, the juicy stuff, the stuff that will take your trading to the next level. All right. So yeah, in today's session, right, there are only two things that we want to do, right? The first one is diagnosing your trading strategy. So if you have a trading strategy you want me to look at, let me know, right? I'll do my best to look at it, right? And if otherwise, right, I will, while you guys are sharing your trading strategy with me, right, I'll also be looking at some trading setups that we can look at together. Okay. Now, let's begin today's session. Okay. Moving on to the charts. Okay, so I'm going to disable my video first because when looking at charts, I'm not sure how the video is, but maybe you should be able to see more of the charts if I hide my video. All right. Okay, let's go. Now, remove some drawings. Now, let's begin today's session. So usually when I trade, right, I'll just be sharing with you guys the approach I take to trading, right? So I usually have a, I use TradingView, right? I use TradingView to do most of my analysis, right? And I have a watch list by the side over here, right? So the watch list, I have my analysis, I got futures, I got my crypto list, I got a market watch, right? So market watch is where I see most of my market watch is where I see most of my all the different, you notice there's all the different majors, right? There's a little bit of the main cryptos I'm looking at, right? In the indices, right? I got the pound, the euro, the Aussie crosses, I got a whole bunch of them by the side. Okay, so this is where I usually scroll through my the different instruments, and I see if there are any trading opportunities there, right? So let's begin. All right, let's begin. So maybe for starters, right, I usually start the day by looking at something like maybe dollar CAD, right? So how I usually analyze the trades is I tend to take most of my trades on the 1-day chart and the 4-hour chart, right? Mainly on the 4-hour chart. But what I do is I actually go onto the 1-day chart to look at the higher time frame to see if I'm missing anything out, right? So as you can see, right, if I look at the 4-hour chart, this is telling me one picture, but I will go into the 1-day chart, right? And then I will zoom out and I'll have a better picture on what is, I have a better picture on what to expect, because, you know, I got a higher time frame over here. Okay. Now, the important thing to take note of is that when you're trading, you don't need to, what's the word for it? You don't need to take every single trade that you're doing an analysis on. Sometimes when you're looking at a market and, you know, you're just looking at it over here and you realize that, man, there is really nothing nice to trade in this market. If there's nothing nice, it's perfectly fine. Move on to the next market. Okay. Now, I can see a couple of new guys are streaming in, right? Like Sahid, right? Temitopi, right? Foibe, right? Guys, if you have requests, if you want me to look at any specific instrument, right? We got Kelvin tuning into, right? If you guys want me to look at any specific trading instrument, right? Or you like euro, dollar, gold, or Bitcoin, let me know, right? Or if you have a particular trading strategy that you like my opinion on, right? You can let me know too, right? And I can share with you my opinion on these trading strategies, right? I've diagnosed many trading strategies in the past, right? I've created many profitable trading strategies. So if you want my opinion on them, now's the best time. Okay. So all right. So like when I'm looking at something like dollar CAD, right, I noticed that there's a lot of fluctuations, right? A lot of fluctuations in between here. In between that, I realized there's not really many trading opportunities for me over here, right? At most, I do notice that there might be a little bit of a channel, but price is mainly in the middle of nowhere. Very few clear trading opportunities for me to trade, right? But the important thing is that I notice if there is no opportunity, you just move to the next one. Now, this is one where there might be opportunity. Okay. So what I like about this, right? So if you're looking at the 4-hour chart, right, you might be looking at it and thinking that, oh man, right? Hey, Natalia, right? Nice to see you tune in, right? I'm not sure if you got your VIP room access already. But if you haven't, let me know, right? I think there was some registration problem previously, but it should be working now, right? But yeah, so, you know, if you're looking at a smaller time and you're looking at a 4-hour chart, you're just looking at prices go down and you think that, oh man, you know, it looks like price has broken a key level of support over here. You're expecting it to kind of go down further, right? So, okay, that's nice, Natalia, right? The VIP room will be a lot more active soon, maybe from next week onwards, because we are just finalizing the last bit of the nitty-gritty stuff, right, on getting it set up. Yeah, but it should be much more active from next week onwards. Now, so the thing with when you're analyzing a chart, okay, guys. So I see a couple of new people streaming in, right? In today's strategy clinic, I'm just going to share with you guys real quick. In today's strategy clinic, we are basically diagnosing your strategy and looking at trade setups. So if you have I can see some questions coming through. All right, if you have a specific kind of trading strategy you'd like me to take a look at, just send it through. I'll do my best to look at it. Okay. Sahid is asking, what is the requirement for the VIP room? The requirement for the VIP room, right, is if I'm not wrong now, they just raised the bar. So as long as you have a $250 live account with IronFX, you can get access to it, right? So you need to go to vip.ironfx.com, right? So this is the link that I'm going to send to you, vip.ironfx.com. Once you go there, you can register for a new account, right? And then you get access to this VIP room over here, right? I think where's Natalia, right? But yeah, come in here, you have access to all the different instruments by the side. And this is where, you can come in here and you can practice your analysis, right? So like over here, you might be thinking, you come down here and draw this support line and you can say, hey, hey, Desmond, do you think price might bounce from this support? What support level are you referring to? You highlight the text, click this button, link object to text, and you can select the object that you just drew, right? So what happens when you send a message through is that you can see it over here. When I read your message, I can hover my mouse over it and I can see, oh, this was a support line that you're referring to, right? So that gives me better context to what you're doing. It's a great place where, you can practice your trend line, you can practice your stochastic, you can practice your channels, your support, your Fibonacci, your harmonics. You can practice anything. And anytime you want me to take a look at something, you just mention me, right? Or, you can mention the other group of prop traders that we have, and we can attend to your question right away. Okay. So all you need to do, of course, you go to vip.ironfx.com, register a new account. And if you have at least $250 in your account, right, all you need to do is to click on this thing called request access, right? And upload proof of your live IronFX account to get full access. So you just need to take a screenshot of your live account with $250 inside, and I will approve it, right? So yeah, you just need to click on this button here, request access. Okay. I think we don't have just let me check. Yeah, so we have actually 2 request access. So like Natalia over here, right? Like to gain access to the VIP room, and she has attached the proof of account size, right? I'm not going to view the whole thing, right? I can see it's over there, right? So it's enough. I will click accept, right? So I'm going to give Natalia a silver tier, right? Done. Natalia, you should have access to all the different channels by the side. I can see this guy, Carlitos, can I have access? He also wants access to it. I can see maybe he has a little bit of, he sent me a screenshot. Maybe there's an error with the screenshot, right? But if he I'll go check with him later. But in this case, we give him the silver tier access, and he will have access to the rest of the trading room. Okay, so take advantage of this opportunity and join the VIP room, right? Because it used to be free, but IronFX have just changed the deposit requirement to $250. They might be increasing it over time. So if you have an IronFX account, please just go and what's the word for it? Register for it. Okay, I think go get your spot. Once you have registered for it, though, you can actually drop me an email, delong@notesco.com. I think this is the email. I'll check the email later, but you can just drop me an email, drop me a message, and I will ensure that your approval is expedited. Okay. A couple of new people coming in. That's great. All right. Temitopi is asking, wouldn't mind some explanation on FVG and order block? Okay, I understand the meaning of order block, but what do you mean by FVG? What is there a short form for something? Yeah, maybe if you let me know, I can dig a little bit deeper into it. Okay. Now let me explain order block in a minute. Okay, guys. So the thing when you're analyzing a chart, right? When you're analyzing a chart, you need to take note that when you're looking at just at a 4-hour time frame, or are you looking at any time frame, a good habit to do is just to go one time frame higher. Go one time frame higher. So I'm at the 4 hours now. I'm going to the 1 day. Once I go to the 1 day, right? Then I might be thinking, okay, I'm expecting prices to drop further from here, or fair value gap. But I'm expecting prices to drop further from here. However, if you scroll further back, you'll notice that there is a major support level right over here, right? Major support level over here, right? Price had bounced from this level 1 time previously, 2 times previously. So it's close enough to that level where, we could be expecting prices to kind of bounce up from there. Okay. So this is the important thing with on why it's important to look at a higher time frame, because we might have been thinking that we're going to just wait for prices to drop down on dollar franc. But if you look at the higher time frame, then you realize that, whoa, there is a major support level that goes back to even, well, the last time price was at this level was at what, July 2020. So it's about 2 years ago, right? So last time price actually tested this level was 2 years ago. So it's a very, very strong level. It might be dangerous for us to try to play the move beyond this level. So instead of trying to go short, so if I was on the 4-hour chart, I was thinking, yeah, price maybe breaks this level, I expect it to go down, right? But then you suddenly realize that it's a little bit hard for you to play the drop all the way down, because there's such a strong support level over here that it will make more sense to play the bounce from here. Okay, so yeah, this is one of the considerations that when you're trading, don't just look at one time frame, look at the time frame which you're going to take your trade on, and then go one time frame higher and see if you happen to miss out any of these trades, right? Do you miss out like a super big support level that goes all the way back for the past 10 years, right? Or something like that. Okay, now guys, let's move on from here. Just give me a second. Okay. Okay, let's move on from here. Anyway, regarding this particular analysis on dollar franc, right? Because I do want to explain it a little bit more. Before I move on to the next pair, right? This analysis, after I highlight my key support and resistance levels. Okay, so in this case, I have a key support level here. I then would do this thing called a Fibonacci projection. Right, this Fibonacci projection, I use 61, 78, and 100. So what you always tend to notice is that the 100% Fibonacci projection is pretty handy. Even the 78 was great. You notice how price touched the 78 and then bounce up a bit, bounce up. Price touched the 100, it bounce up, touch the 100, it bounce up. So these are what we call Fibonacci projection levels. If you know how to use them accurately, they are very, very effective in being able to call little reversals. They are one of the only, right? They are one of the only leading indicators out there. So in trading, sometimes we have lagging indicators, sometimes we have leading indicators. So what are lagging indicators? Lagging indicators, right? Lagging indicators are stuff like your moving average, right? Your moving average is usually a lagging indicator. Your stochastic is a lagging indicator. Your RSI is a lagging indicator. Even Bollinger Bands are lagging indicators. Many of these are lagging indicators, right? That means they require price to move first. Only when price moves, then it moves along, right? So this is what I mean by lagging indicators. So they are usually one step behind the market, right? Moving averages are one step behind the market because you require the market to move first, right? You require the market to move first before you move. So then again, it leads to the next question. What are leading indicators? Leading indicators are things that forecast, what's the word for it? They get to forecast price in advance before it even happens, right? So for example, in this case, a leading indicator like Fibonacci, what it does is that it forecasts at 100% projections over here. So it's forecasting that price will come down, touch the 100% and make a small bounce, right? So we can see, when it comes down, it touches the 100% and that's a small little bounce from here. Okay, you can see that it touches, then it bounces, right? So that is what a leading indicator does. In trading, it is important that you have a combination. You have a combination of lagging indicators and leading indicators. And so there are three kinds, right? There is I told you there's lagging, there is leading, and then there is right in the middle. Right in the middle is what you call price action. meaning this is when in the thick of the action, when things are happening. This is things in the past, these are things in the future. Okay, so in this example, right, so if I were to give you an example, lagging indicator could be a moving average, right? So maybe you have a moving average that is like support over here, right? You have a long moving average that is like support. So this is one reason why it might bounce. Okay, then you have a leading indicator. A leading indicator like a Fibonacci projection, right? It projects that this 100% might be a level where price might bounce off. So we got lagging and we got leading. What about price action? Price action is maybe when price just touches this level. You look at this. We have this kind of different kind of price actions. I know it's a little bit hard to see. That's why I'm going to come in here. I'm going to remove all my brushes, right? So maybe when you reach over here, right, what you then notice is that there's this price action over here. There's a bullish engulfing candle over here, right? There's a long wick rejection over here, right? So these are things that it forms the third part of the puzzle, right? You got lagging, you got leading, and you got, the past, basically the past, the present, and the future. When you combine all of it, all three of it together, you get a very high probability trading setups, but you must combine the right things. All right. So in this case, Fibonacci's are a leading indicator. It forecasts 100% over here, right? At the same time, we got support and resistance. You can see a very nice support in the past over here. And then, of course, we have, let's see. I think that is most of the, that's most of the reasons why we think price is going to go up. I think there's a short-term channel breakout. There might have been a short-term channel breakout somewhere about here. Right, you can see price was going lower. Price was going, oh, sorry. You can see price was going lower in this channel and finally broke out from there. So you now have a couple of reasons, right? You have 100% Fibonacci projection. You got a nice channel breakout. You got, you got one here. We got two here. We got a nice support level over here, right? Three reasons why price might bounce up, right? And we throw an indicator, maybe look at the stochastic. Stochastic, I like to use 21, is it a 5-3? Or is it 3453? There are some numbers that work better than the others, right? Stochastic, nice bit of stochastic that is turning upwards, right? We can see stochastic slowly going upwards. So there's a lot of upside potential, right? So this then shows me that how I got 1, 2, 3, and maybe 4 reasons why price might go up, right? If you look at it, there is bullish divergence. Stochastic is making lower highs, right? Price is making, right, lower lows, and lower lows, right? So there's bullish divergence here, right? So now you got 1, 2, 3, 4, 5 reasons why price is going to go up. So when it comes to trading, this is basically all there is to it, right? You need to try to find more reasons why price is going in the direction that you expect it to go than the reasons against it, right? So in this example, I have so many reasons why price might be bouncing up, right? I got a nice 100% Fibonacci projection. I got a nice channel breakout over here, right? I got a nice super long support that goes back for the past 2 years. I got stochastic that is bouncing upwards, and I got a bullish divergence that is that's showing that price is going, is likely going to make a bounce. So when you combine all of this together, this is what we call a high probability setup, HPS, right? A high probability setup. You are combining this is a leading indicator. This is chart patterns. This is these are called indicators, right? We're combining divergence. We're combining support and resistance, right? And we're combining an oscillator. So you combine all the different kinds of studies, right? Just to give yourself the highest chance of being correct, right? So the reason why we combine different studies is that we cannot be biased. Right? What I mean by that is that sometimes a mistake that most people tend to do, right, is that they load too many indicators that belong from the same family. Now, what do I mean by that? Right? So they might load an indicator like the stochastic, they load the RSI, they load the MACD, Did I load the MACD? MACD, right? Now, so these are all oscillators, right? And then you look at it and you say that, all right, RSI looks like it's going upwards, right? MACD looks like it's going upwards, it's going to cross, right? So all of these are essentially oscillators. So they are telling you the same story, right? So this one says yes, this one says yes, this one says yes, it's going upwards. If you are not careful, you will have, you will treat this as three separate ticks, right? You will treat it as three separate ticks, and then you'll be very confident. But the danger is that the RSI might be just telling the same story of the stochastic. The MACD might be telling the same story as the RSI and the stochastic. So they're all actually telling you the same thing, right? But just from just different forms of oscillators. So one tip that I have is that if you find yourself doing this, please don't do it, right? Try to combine different studies of analysis, right? So if you have one oscillator, that is enough. Having one oscillator most of the time is enough. Then you look at support and resistance levels. Then you look at trend lines and channels, right? Then you look at Fibonacci. Then you look at Ichimoku, right? After you look at Ichimoku, then you look at maybe divergence, right? So you combine different things to really give yourself the best chance of being profitable on a trade. Now, Temitope, fair value gap, I roughly understand what fair value gap is. I will need to dig a little bit more into it, right? I roughly understand it's more something similar to demand and supply zones, like price tends to reverse to fill up the fair value gap or something, right? I'll need to do a little bit more research into that to give you a proper answer. But I believe it based on what my initial understanding of it, yeah, fair value gaps is basically like a different version of supply and demand, right? So there is a lot of there are reasons why it will work. Okay, I will, however, now move on to the next part, right? I will now move on to guys, right? Got a whole bunch of you guys here. If you want me to look at any instrument, let me know, right? So I will just pull it up and I'll just look at it. Okay, I'll do an analysis on it, and you can watch me analyze the chart and maybe look at find some trading opportunities. In this case, we're expecting dollar franc to go up. So if it goes up, that's great. Okay. Now let's look at other stuff, right? Okay, one of the instruments I was watching is actually Kiwi dollar. Okay, what do I like about Kiwi dollar is that it is very strong bearish momentum. I think there might be a bit of a channel. Tweak it a bit. Bearish channel. So you firstly have a bearish channel on Aussie dollar. Okay. Okay, Sahid, if there's a particular indicator that you want me to teach, let me know, right? Some of it are a little bit more advanced, some of it are a little bit more straightforward. But if there's a particular indicator which you want me to explain a little bit more on, let me know. Or otherwise, I will try my best to explain it along the way. All right. So this thing is called a channel, right? This thing is called a channel, right? And a bearish channel means that prices are going down, right? So bearish channel means that prices are going lower, 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 lower. You're expecting prices to kind of go down, okay? Bullish channels are the opposite, right? Bullish channels, you're expecting prices to go up. It's usually green in color, okay? Now, this bearish channel. So first thing we establish, number one reason, right, why price might go down is bearish channel, right? Bearish channel, I'm going to call it BC, bearish channel. The second reason, throw up the Ichimoku. So the Ichimoku, so I use the Ichimoku in a slightly different way, right? The Ichimoku Kinko Hyo is actually Japanese for charts at a glance, right? The original indicator is actually very, very complicated, right? You look at it, there's so many things there, right? So they have a lagging span, the Chico span, right? You got all this different stuff, but I feel that it's a little bit overwhelming, So what I like to do, one of the most effective tools of the Ichimoku is actually, once you disable everything, is the cloud. It's the Ichimoku cloud. You can see there's a nice little cloud over here. The cloud means something simple. If price is below the cloud, it means that there tends to be bearishness. If price is above the cloud, right? If price is above the cloud, you tend to see a little bit of bullishness. That means price tends to go up a little bit more. Now, this is not guaranteed, right? Rather, this is just one of the reasons. This is just one interpretation, right? So in this case, I got Ichimoku, I got bearish, right? The third reason is that now I'm looking at this and I see that there's a nice descending resistance line pushing prices down. And if I go down under the smaller time frame, there's also another, you can see that price is being squeezed down here, right? On what I like is on the smaller time frame, you notice that we're on the 4-hour chart now. On the 4-hour chart, price is below Ichimoku, right? On the 1-day chart, price is also below Ichimoku. So this works on both time frames, which is great for me, right? It means that they're both, we're seeing bearishness on the higher time frame and the lower time frame, right? Now, okay, I'm just going down the 4-hour chart now, and I'm seeing this over here. Oh, sorry, let me come down to here. Let me just remove some of my drawings. Okay, so price is going down, is going down, is going down, is going down. How low can it go? Right? How low can it go? Right. So now the key thing is that if we see that there's so much bearishness, right? If we think that price is going to continue going lower, what do we do next? Right? The next key thing is to decide when would be the best time to sell. When would be the best time to sell? There is, however, one risk I notice over here is this little thing over here. Is this little support line, right? This line is irritating because every time price comes down here, it bounces up. Comes down here, it bounces up. It comes down here, it bounces up. So this to me is a risk level, right? Price has bounced multiple times in the past on this level. So I would need prices, I'm afraid that price might bounce and continue to go up. So what I need to do is I need to use this as what we call a downside confirmation. Only when price breaks this level, right? If price breaks this level, then it might continue down further. Okay. If price breaks this level, then it will continue down further. So this is an important thing to note. You can find all the reasons why price might be bearish, right? Like a channel, bearish channel, bearish Ichimoku, bearish trend line, right? But you must wait. When it comes to trading, it's slightly different, right? Analysis is one thing, but once you have the analysis and you basically tell yourself, okay, man, Aussie dollar, AUD USD looks really bearish, right? That means it looks like there's a lot of downside momentum. Once you have the idea in place, then you look for your trading opportunities. You try to put that idea into action, right? To put the idea into action, you need to know what is your entry. In this case, we can see that because this is a key level of support, we need prices to break this level to trigger the move down, right? So in this example, right, price needs to break this level. I'm going to call this sell entry. So price needs to break this level, and only once you break this level, then you can expect it to go down lower, right? How low can it go, right? It really depends, right? If prices goes lower, it might continue to respect the channel, right? I think that the channel, channel could continue down much further, right? So it could go even all the way down to maybe the next key support could be about here. We don't need to play the move too far. You could easily just play the move down to here, right? And you keep a very tight stop loss, right? That will make you a good enough risk to reward trade. Okay, yeah. So this is one example of using a high time frame to filter out some trading opportunities. I will continue to scroll through the different charts, but now there's another thing called correlation. Right, so Australian dollar and Kiwi dollar, what do you notice? I'm just moving between the two now. They are they tend to be very similar, they tend to move together, right? When one goes down, the other goes down. When one goes up, the other goes up. Now, let me teach you now the concept of correlation, okay? Correlation, so I'm going to click this plus button, AUD/USD, okay? And I'm going to put it on the same pane, right? And I'm going to change this to a line chart. What do you notice, right? I'm going to hide this Ichimoku. You notice that these two instruments, these two AUD/USD and NZD/USD, they tend to go down, go up, and go down, and go up, and go down, go up, go down, go up, go down, go up. They tend to go down and go up together. This means that they are positively correlated. So when one goes down, the other goes down. When one goes up, the other goes up. So based on this same theory, right? Based on this same theory, when one has a breakout, the other should also have a breakout, right? So in this example over here, right? We expect prices, right? You know, if price breaks this level, it should go down. If price breaks this level, Kiwi dollar has to break this level too, right? What do I mean by that, right? Is that this is the support level on Kiwi dollar. This level on Kiwi dollar is this level on Aussie dollar, right? If they both are broken at the same time, you get a very high chance that your breakout is going to be successful. But if they don't break out at the same time, one breaks out and the other one doesn't break out, then you know that there is something that is not, there's something that is wrong in the markets, right? That means there's a disturbance in the force, maybe, if that's what you call it. There's a disturbance in the force, right? It might be better for you to avoid that trade. So many times, I get questions asking, how do you avoid getting faked out of a trade, right? As in, like, how do you avoid false breakouts? A lot of us love to trade breakouts, but many times when we think that, imagine we're over here and we think that, okay, price has broken out. The moment price breaks out, we try to play the move down, but price then comes back up and then it stops us, it hits our stop loss. How do we avoid this happening, right? Because it's the more it happens, the more money we lose, which is not very nice, right? So one of the ways they can use to really avoid this from happening is what I call the correlation filter. Okay, so in this example, right, if this is the support level, then this will be broken. Once price has broken out from here, I would then look at our good friend Aussie dollar. If Aussie dollar, which we expect to break out from here, if it instead bounces up, right? So one is going up, in this case, one is going up, but one is going down. That means there's something wrong, right? That means this is likely going to be one of them is right. Basically, one of them is right, one of them is wrong, right? It's a false breakout. We would avoid trading this because we have a lower probability of succeeding. Right, we have a lower probability of succeeding because the markets are not moving in tandem with each other. However, if Kiwi dollar breaks out and then I go to Aussie dollar and it also happens to be breaking out like a bearish breakout, and then I know that the market is singing from the same hymn book, right? Both of them are moving in tandem, both are moving together, and that means that I have a higher probability chance of being correct. Okay, I hope that this concept of correlation helps you understand how to avoid getting caught in false breakouts. I do want to encourage you guys that if you have questions, right, you want me to look at a certain currency pair, you want me to look at a certain instrument, right, or you have a certain style of trading which you want me to give my feedback on, please just send it in the chat section and I'll do my best to look at them. Okay. Otherwise, yeah, we're just going to continue to scroll through. Oh man, this trade worked out so great, right? Yeah, this trade worked out so great. How I got into this trade, right? Let me see if I have an example on when I made this. I made the call of this trade live. Let me see over here. And I'm going to explain to you how I got it, and so maybe it gives you an idea, right? So this was made by me on the 28th of June, right? So I did an analysis on the 28th of June. I'm going to mute this, and the idea with the analysis is that on the 28th of June, we are calling for price to drop from here down to this take profit level. Look at the risk to reward. The risk to reward is like 1:1, 2, 3, 4, 5 or something. It's a great risk to reward setup. Okay. Now, how did I make this? How did I make this trade? Right. Clearly, we can see that the trade has worked out very nicely. Drop and is about at our take profit. Right. But how did I make this trade? Let me show you. When I was looking at this strategy, right, I'm going to do a bar replay. I think the market was about here. Okay. One thing I noticed, right? One thing I noticed is that I scroll back and I noticed that prices was dropping, lower and lower and lower and lower and lower. It was dropping lower and lower, right? So in this example, right, there is a very strong bearish. There's a lot of bearishness that's pushing prices down. Okay. At the same time, I was scrolling back and looking for support, right? It is clear to me that there is a very nice little support over here, right? Price bounce off it once, right? You can see price bounce off it once, and then it bounce off it again, right? So in terms of my take profit, if you notice, I don't play my take profit further than this level, right? The reason for that is because with such a strong key support level over here, it will be foolish for me to try to play my take profit all the way down, because price, this is clearly a big level of support. It is unlikely that price is able to break this and go all the way down. That's why we only play it to the highest degree of certainty, right? In this case, I'm very certain that price might go down to there, but you ask me whether I'm very confident that price will break out from there and go even lower. I can tell you that I'm not confident of that, which is why we need to play it safe, right? So in this example, I played down here. Now, how did I get this trade then? Right? What I did was, when I look at the chart, I threw up my Ichimoku, right? I noticed that price has been respecting Ichimoku very nicely, right? You can see it takes, it go down. Below, it go down. It test it, it go down. It test it, it go down. Test it, it go down. Go down. It test it, it go down. Now it's over here again. It's testing it. So you will tend to notice that there's this certain pattern in Ichimoku. If you notice that the recent price movements have obeyed Ichimoku very well, like it has been testing it and it has been behaving well based on Ichimoku, then you can use Ichimoku. When is a bad time to use Ichimoku? Rather, a bad time to use Ichimoku is when prices are ranging. Right, so maybe give me an example when it's ranging, like here. This is when it is ranging, and it's a terrible time to use Ichimoku, right? It goes up, goes below, it goes above, it goes below, it goes above, it goes back above, right? It goes back below, it goes back above, it goes back below. So in this example, right, Ichimoku is not that great, right? Ichimoku has a lot of what's the word for it? There's just way too much noise, and you want to stay away from Ichimoku. You want to stick to Ichimoku in moments like this, right, where there's a clear trend, right? To trade using Ichimoku. Okay. So back to the latest drawing that we have over here. How did we manage to call euro dollar? How do you manage to call this drop on euro dollar so perfectly, right? Quite simply put, after I've established that Ichimoku is pushing prices down, I then look at chart patterns, right? One of my favorite chart patterns is the channel, right? So I notice that the channel is also suggesting that prices will continue to drop more, right? Because it has been reversing, and it's testing this level over here. So I got the channel, I got the Ichimoku. Two reasons why price might be dropping, might continue dropping. And then I look at the resistance level. We have a very nice overlap resistance over here, right? Overlap resistance, you look at the past webinars we did for IronFX, it will explain to you what is this overlap resistance. It's a very good way to find reversals. Okay, overlap resistance is my third point why price might be dropping nicely. Okay, so these 3 points add up together, we figured price might drop. But how far can it drop? How far can it drop, right? In our example over here, you can see that we only call it to the recent swing low. So in trading, it's important for you to know exactly where is your take profit. There must, a lot of people tend to focus just on the entry. right? A lot of people focus on getting this entry. Once they get the entry, they randomly put a take profit, they randomly put a stop loss, right? Which is a shame, right? Because the take profit and stop loss levels are as important as the entry. Let me repeat that again. Your take profit and your stop loss levels are as important as your entry. Okay, so in this case, once you establish the entry, you need to spend an equal amount of time to decide where your take profit is going to be, right? Don't just throw your take profit to any random level. So a lot of what's the word for that? A lot of forums out there, maybe on Baby Pips or these Instagram traders, they just give you a very simple trading strategy. They say that, okay, when you see a trading pattern, give yourself 50 pips stop loss and 50 pips take profit. Okay, let's see what will happen if we did something like that. Okay, I'm going to remove this. Oh, not 50. Let's do like 500 or something. So we have a short order over here. So bam, this is your trade, and you put your take profit. Let's just say you put your take profit at 500. No, at 300. So you notice your take profit is, you look carefully, right? There's this number 307.4, right? 307.4 is 300 pips of profit. So sometimes when you look these trading educators out there, right, they say just put your take profit at 300 pips or something, right? So the problem with that is that if you were to put your take profit at 300 pips, the take profit will be down here. Okay. However, there's a key support level over here. Right? I'm going to put this as a support, which is green color, right? And this is your take profit. Let's not worry about our stop loss first, okay? Let's not worry about our stop loss. Let's look at take profit, okay? What happens is that price then drops down to here. And when it drops down to here, it touches this level and then it bounces up. That's the problem with having a take profit that is beyond a key level, right? Most of the time, it might cause you to miss your take profit. There's a rule that I want to say. Take profit is, you know what, I'm just going to write it out instead. Take profit before key level. Stop loss beyond key level. This is an important point that you guys need to know. I'm going to make it so big so that you guys can see it, right? Put your take profit before a key level and put your stop loss beyond a key level. That will give you that will instantly improve the hit rate of your trades, because in many situations like this, right, if you randomly put your take profit at 300 pips, like down here, what happens is that price will go down, okay? And when price goes down and it touches this key support level, it bounces up. And then you're wondering, oh man, is the market being manipulated, right? You're wondering, man, why did price bounce up from here? Is the market being manipulated? Why? How can it just avoid my take profit and just it just goes against my trade, and maybe goes all the way to stop you out, right? The reason is because of your take profit placement. There's a better way to put your take profit, and that is putting your take profit before any key level. Okay. The opposite is true, right? That means your stop loss should be beyond a key level, right? You should always put your stop loss beyond a key level to give it that bit of breathing space, right? Just so that you don't get stopped out when price goes to your key level. Okay. Important considerations. Now, we do still have a little bit more time, guys. I see quite a number of additional guys streaming in here in our trading strategy clinic. I'm open to taking your questions, right? So if you have a particular trading style or trading strategy that you want me to take a look at, or you want to share and I can give you my feedback on, let me know and I'll do my best to look at them. And also, if you have a instrument that you want me to look at, maybe euro dollar, pound dollar, or gold or Bitcoin, If there's a particular instrument you want me to take a look at, let me know too, and I'll do my best to get to it. All right. Now, okay, so this is on euro dollar. Let's see some of the other instruments around, right? Which one has, so when I'm looking at stuff like that, right? If I'm looking at stuff like on the 1-day chart and I see this, I know that there's almost nothing I can do to trade. It's so hard to trade this, right? Just price is just going up and up and up. So I tend to avoid it. Pound dollar, I like to zoom out, see if there's any key level which I'm missing. Not really, nothing nice on pound dollar. Swiss franc, nothing much too, right? So I would then scroll through the different charts, right? And I see if there's anything I'm missing, right? Interesting here. Interesting. Still waiting on a couple of key levels to be broken. This one maybe. Pound franc might have a trading opportunity. I'll be sharing with you guys in a bit what I think might happen with pound franc. Pound franc has idea. Okay, so this is really honestly what I do every day. I just scroll through the charts and I see if there's anything that jumps out at me right away. I go in, I go out, I just zoom in and zoom out, look at the key levels, and all right, maybe we have, oh man, this trade worked out so nicely. Okay. We got EuroCAD. Oh, EuroCAD looks interesting. Is there another big level it might drop to? Okay, so this is the thing I noticed about EuroCAD, right? It's another nice trading opportunity I'm seeing. Nice bit of bearish Ichimoku cloud that is holding prices down. So we have one reason why prices might go down. I like this little bit of a, price is going down, 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 down. It's going lower and lower and lower. Right, it's a very, very good sign for me that price is in a nice descending trend. The important thing that I need to do now is I need to look for a breakout. I can see that price broke bounce out and bounce twice, bounce 3 times. It might be bouncing a 4th time over here, but this is my key trigger level, right? This is my trigger level. I put it over here because if price is able to close below this level, I am pretty sure. All right, I'm pretty sure we're going for a free fall, right? So this is my sell entry. If price is able to close below this level, we might go into a free fall. Where would it free fall to? This is where I will zoom out, zoom, right? And I realized that, whoa, the only level it might free fall to next is probably over here. This is the next big free fall level, which if you look at it, man, it's a very, very good juicy trade if it works out nicely, right? So of course, in this example, our first need for prices to break below this level. Once it breaks, it should trigger a drop. It should trigger a big free fall all the way to this level. And this was the big level since April 2015. One big bounce. Price hasn't came back since, but this is clearly the big support level to watch out for. Okay. Now, I hope you guys found this session useful. If you have not joined the VIP room, please head over to IronFX, vip.ironfx.com, right? Register for a free account over there. As long as you have $250 in your IronFX account, right, you can send a screenshot over to me, right? You just need to click request access and send a screenshot over. If you have $250 in your IronFX account, you will get access to the VIP room where you can ask me questions. You can trade alongside me. You can ask me, you can see the trading ideas, the trading signals that we're going to put inside here, right? Many high probability setups that you can look at and you can take your trading to the next level. But first you need an IronFX account with a minimum of $250 in it to get access to this. Okay, guys? If no one else has any questions, right? Thank you so much for staying with me throughout this entire webinar, right? Nice to see you back here, Natalia, right? Hope to see you in the VIP room. It's going to get a lot more active, right? Once we roll it out to out of this beta testing phase, right? It's going to be a lot more active and there's going to be a lot more training ideas that are being shared in there. Okay, I hope to see you in the VIP room. Thank you, Sahid. Yes, please, if you can, head over to the VIP room and you can practice your analysis there with me. right? We've got a strong team of prop traders, professional traders, trade for a living, right? And of course, you get access to the My Trading Ideas too. Okay. Thank you very much, Natalia. Thank you, Sahid. Thank you, the rest of you guys. We've got Javette, Simon, Merritt, Kelvin, right? Thank you, guys. Hope to see you around the VIP room. Take care. Stay safe, trade safe, and peace out, guys. Take care, everyone. Bye-bye.
Hello everyone, my name is Emily. Last time we looked at what candlesticks are. In this video, we will look in more detail at candlestick patterns. Candlesticks are created by the changes in the price of an instrument. These price movements can be random, but sometimes they form patterns, what we call candlestick patterns. There are various types of candlestick patterns which can be bullish or bearish. The bullish ones show that the price could rise, whereas the bearish ones show that the price may fall. While no pattern works 100%, candlestick patterns represent trends in price movement. Here we will look at some of the candlestick formations and how to read them. One of the things to look at, apart from the colors, is how long the body of the candlestick is. The longer it is, the more buyers or sellers there are. On the other hand, short candlesticks suggest there is little price movement and represent consolidation. If the white candlestick is long, it means the further the close is above the open. This indicates that prices rose sharply from open to close and buyers were aggressive. On the other hand, long dark candlesticks show strong selling pressure. The longer the dark candlestick is, the further the close is below the open, which shows how prices fell sharply from the open and sellers were aggressive. Let's look at some of the candlestick patterns in more detail. A bearish engulfing pattern develops in an uptrend where there are more sellers than buyers. This candlestick appears as a long red real body engulfing a small green real body. The pattern indicates that sellers are back in control and that the price could continue to fall. A bearish engulfing pattern occurs when there are more buyers than sellers. This is shown by a long green real body engulfing a small red real body. With both taking control, the price could rise further. Candlestick patterns can also be blended or merged to form another candlestick. For example, a hammer can be created by blending a bearish engulfing pattern or a piercing pattern. Similarly, a shooting star is created by blending a bearish engulfing pattern or dark cloud cover. Additionally, more than two candlesticks can be blended to create another candlestick. Blending three white soldiers creates a long white candlestick, while blending three black crows creates a long black candlestick. Hope you found this video useful. Stay tuned for more. Bye-bye!